Hi, everyone. Some of you may know me. I'm Julian Brigden. I run MI2 Partners. And you might have also seen me with Raoul producing Macro Insiders. And today, the team has kindly invited me back to kind of give a brief sort of overview of how we see the world.
Current macro outlook.
We've been very, very bullish since the 24th of March. Basically, back then, we started to play some of our bigger themes, buying into things like precious metals. We had a great run on things like silver and gold miners, and also trying to sort of short the dollar, which we thought basically was at a high after the squeeze. And we've had some nice little trades on the back of that. So things are just becoming a little bit more nuanced. And in part, that's because one of the drivers of this reflationary trade has been some of the soft data. So if you look at things like ISM manufacturing data, and the reality of the situation is some of this is about as good as it kind of gets. So if you look at this chart here, you'll see we've seen a very rapid rebound in ISM manufacturing. Actually, the rate of change of the US equity market tends to follow this quite closely. And the only issue is while it's great, the model is suggesting this is about as good as it ever gets, right? The big question at this point is the fiscal stimulus going to enable us to sort of sit at these sort of 60 levels in ISM manufacturing and bang along the kind of ceiling so we get a sort of 2016, 17, 18 type situation? Or do we get this one-off sort of touch that we got in sort of 2004 or 2011, and then we settle back into the sort of low 50s. Now, they're not bad. That's still commensurate with sort of 2.5% GDP growth, but it isn't going to be that explosive growth that which we saw in 16, 17, and 18. So that's just one area where there's a little bit more nuance. The other area of nuance is I think we've got to be a little bit careful about some of the speed of the rebound. So if you look at this ISM manufacturing data, it's been a very rapid reacceleration, but really this is a month-on-month metric. What it tells you is the rate of change, not really the level of growth. And there are some areas that we're actually a little bit concerned about. So for example, if you look at this chart here, this shows you year-over-year GDP growth. Now, it's not where I think actually year-over-year GDP growth is coming through. I think it'll come in higher, but just look at consumer confidence against this. What this suggests is really it should be GDP growth should be at -2%. Now, we know it won't be, and this will be courtesy of this fiscal spending. But once again, it's a sign that things are a little bit under the surface and not quite as sexy as they appear at face value. And the big issue overall is employment in the US. Where are we going to end up settling unemployment? And when we look at something as simple, let's say, JOLTS data against total private sector non-farm payroll, you can see in this chart here. The good news is we think in this waxing and waning that we've got courtesy of COVID, there's probably another 4 to 5 million jobs to be created. The bad news is it doesn't look as though we're going to go back to where we were in 2019 when we had 130 million jobs in total in the US economy. We're probably looking at something like 126, 125 million, which means we've lost somewhere between 4 to 5 million jobs. That's going to give us 6 to 7% unemployment rate when the kind of dust settles. And that is fundamentally the biggest issue that is facing the US, which is why actually we believe that there's really a solid need for ongoing fiscal and monetary support.